It's live.
Okay. I think we are live, my friends. We are live. All right. Well, welcome everyone to MoneyWi's Wednesday. Super excited to bring you a really cool topic today. As you see, we have some fun backgrounds, changing it up just a little bit. If you're listening to us through audio, basically what we have behind us are beautiful homes that we would all either love to live in, or maybe a second or third home would be pretty darn nice, but
right.
Yeah, I love it.
And so one of my views really quick before we kicked off, they were teasing me because I had no trees and shade. But what they fail to realize is that I have lower maintenance. All I have to do is cut the grass. I don't have to rake the leaves. I don't have to worry about storm season. So bye.
That's right. That's easy. Kelly looks like she's living in a posh place that's got a maintenance or a lawn person for her. So she just paying someone else to do it.
Absolutely.
Oh man. And you know what? I got my almost teenage son mowing with mine because he owes me some money. Okay. So he's working for it. That's true home ownership right there, is when you put your to work to clean up the yard.
Absolutely.
All right. Well, we are super excited to teach you guys today about considering home ownership. So this workshop is definitely for folks who are considering home ownership for the first time. We're going to talk about the financial preparedness of that, some of the also practical things about home ownership that cost some money. And our wonderful, beloved Kelly Merck is going to be teaching and leading our lesson today. So you are in for a big treat. So Kelly, you want to just off here and I'll get our power.
We'll just jump right in.
We'll jump right in. Oh, wait, hang on. I just realized I clicked on the wrong thing. So y'all just give me one here.
That's all right. That's all right. So while we're discussing Kelly getting everything ready and Kelly preparing to lead the webinar today, I'm going to share just about 2 seconds of my first experience of home ownership and preparing for it. Just so the world knows you're not alone. I was intimidated, completely intimidated, did not know anything about what the process itself was about to undertake. So if I had this opportunity to hear and see myself then, what I know now, as Kelly is preparing to share with you all, I would have been so much more comfortable going through the process. So for those that are listening, listen up. For those that are watching, take heed to some of this information that Kelly is going to share. It's pretty cool. It's you know, it suppresses the anxiety surrounding the entire transaction itself. And I think you're probably going to pick up a few gems along the way. So off you go.
Definitely.
Yeah, absolutely. Herschel, I was in the same boat. So I think that's what makes this such a good topic for us to talk about, because, and I don't know if Kelly was in the same thing, but we didn't have a clue what we were doing. None. We just kind of were like, okay. And just to know that this information is out there, and to know that just picking up these little bits and pieces while you're considering and getting ready to buy a home, it will just make the world a difference. It was like when we bought our first home versus when we just bought our last home. The things that we knew, if I knew then what I know now, it would have been a whole different story and a whole lot more pleasant. So let's get started. Again, it's considering home ownership, and we're all going to talk about it together. So it's not going to be me leading. We're all going to interact and talk about our experiences along with it. So in this workshop, we're going to review the costs and responsibilities associated with home ownership. We're going to explore the loan and repayment process, and we're going to learn how to find out if you're financially ready to buy a home. Number 3 is the biggest part.
I agree.
So before we get started in that, we're going to talk about the pros and cons. Like, a lot of times we'll look at things and think, well, that's a pro or that's a con, but let's look at a home has long-term value. You need to make payments towards a home. You need to pay taxes on a home, and you can remodel your home any way you like. So when we really look at those, each one of those has a pro and a con with it, right? So a home has long-term value. A home can have long-term value. The value of the home may go up over time, and you have equity in your house and everything's great.
Oh, I think we may have lost Kelly. Herschel, can you hear her?
I can't hear her, but considering
the con is that value over time, just depending on the economy. Yeah, go ahead.
Kelly, we were starting to lose you. We had a bad connection
Yep,
here. But
I saw that.
think
I
you came back
apologize.
in. No, you're good. I
So-
think you came back in. So
Okay, so
Keep
the
on
value of
rolling.
the home may go down over time, so that investment that you're making may not increase the way you thought it would. And then you need to make payments towards a home. So a portion of every every month payment goes towards your principal balance. And the closer you get, the more value you have in your house. The con is that you may need to make a large down payment up front. So we're going to talk about that. We're going to talk about how to save for those down payments and things like that. You need to pay taxes on a home. So the pro on that is that homeowners are able to deduct the mortgage interest and property taxes on their income tax return, but you still have to pay taxes.
Yeah, huge plus, huge plus. It's definitely a plus for sure, especially whenever you're looking at doing any type of home improvements through accessing the equity in the home. And a lot of these terms that myself, Kelly, and IE are going to be sharing with you all, please refer back to the content that we're sharing on the screen, but pick up again some of the verbiage that we're offering, because it will come into play at some point. I can promise you. I just tapped into my equity and did some upgrades to my home, and it makes that home that much more comfortable for you. It's not for a future sale if that's not what you're interested in. It's not for anything other than providing that comfort for you, because that is your home.
Right, and that leads right into the last one, and you can renovate and decorate your home any way you want to, but guess what? You're responsible to pay for it. So that's a big thing to take into consideration, and your equity is a good part of it, but just know that it's on you. And then we've got some common terms that we're going to talk about. So Kelly, can you share with us some of our common terms?
yeah. So income, pretty basic. I think you guys know it's money earned from your wages. It could also be Social Security or investments that you have. Your income history is your proof of employment. Okay, it's your lenders are often going to require that you show at least 2 years of income history and that you have stability in income. And then we're going to talk about debt to income ratio. This is a big one. This is really, really important. It's a percentage that measures how much a person's monthly income goes toward debt payments. And we're actually probably going to talk about this a little bit later on. And it's really easy to calculate your debt to income ratio, which we also call your DTI.
Yep.
And then your credit score. This is your 3-digit numerical score that predicts your ability to repay a loan, basically your report card on how well you've been at repaying borrowed money.
I love that report card, right?
Yep. And then down payment is a lump sum of cash used to pay for part of your home that shows your lenders that you're committed to the purchase. Not only does it show your skin in the game, it may be required as well. And that's less risk for, the lender as well.
Perfect. Thank you for sharing those with us. And so understanding your credit is the first step in home ownership. So Herschel, can you explain the 5 C's of credit for us?
Yeah, I'd be happy to. The first C in the 5 C's of credit is capacity, your present and future ability to meet your payment obligations. Capital, your assets, including cash, savings, plus any large purchases that you have of value, such as investments, property, etc., that you could sell quickly for cash. That's capital. Collateral, property or assets offered to secure a loan. That's you give me something, I give you something. We're going to put you on training wheels. I don't trust you wholly, right? But you're going to have to continue to prove that until you do so. I need something just to hold close to myself in case you decide you want to run away, right? That 30-year mortgage is probably the longest, biggest commitment that you'll make financially in your life. So for someone to say that, yes, you need some collateral, don't take that as a personal hit towards you. It's just reducing the risk associated with lending you the money for 30 years to live in a home, right? Character, your history of delivering on commitments. Character is everything. That goes both financially as well as in your personal life. Conditions, the purpose of the loan and pay factors that might affect your ability to repay. 5 C's of credit.
Hey, can I interject here, Kelly, real quick with something?
Absolutely.
I was thinking about the character one, and that's that I think a lot of people probably teach in regards to financial education. But, I was thinking about a couple weekends ago, my husband and I went with his sister and brother-in-law to help move in their college daughter to her new apartment to report, for the semester. And one of the things that we were talking about, me and my niece were talking about, was she said, oh, I think I'm just going to open up a new account with a credit union over here because it'd be easier for me. Well, her account with her current credit union, she's had for many years. Her mom set it up for her when she was young, as a minor. And she was like, she's like, what do you think I should do? And I was like, well, I really.
She asked the right person then. She asked the right person.
Well, first of all, I was super honored, that she was asking me because, you want your family members, especially the young ones, to really have someone to talk to. And, who knows? Sometimes we don't listen to our parents. I know I didn't listen to my parents, but when you have somebody else kind of validating something, it all become true, but with her, I told her, I said, I really feel like if you just learn to use the tools that you have to still do your banking remotely, that relationship with your current financial institution could mean like volumes when you go to get your first auto loan. It's like how long you've built a history of banking with your financial institution, whether it's with Envision or not. It really matters when you walk in the door and you say, I need to borrow money from you. You do that. I think every decision that we make, because we're the preferred financial institution, we may be more likely to see, because we can kind of see your character through your history because you stuck with us, what I mean? And I don't know, I just wanted to share that story because as a young person, she doesn't understand or know the value of that. She's got to learn life experience, right?
Yes.
But I was like, hey, go ahead and open the other account. That's cool if you feel like that's going to be easier for you, but still keep a relationship with the one that you have a long tenure with, because that could be huge for your first loan in your own name without a parent on it, and that sort of stuff. So
that's pretty cool.
That story, because I think a lot of young people who are also dreaming of being first-time home owners, whether it's in the near or, whatever, however far away, that really matters. I think it really matters.
Kelly, and I think the key word in that is relationship.
Relationship banking. That's
it's relationship banking. And there are things that your credit union will do for you because of your relationship with them that you may go to another lender and they're not going to do, especially if you're young and don't have a lot of credit. So relationship banking is the key in that, what she said. And it stands true your whole life. Like it's not just when you're younger. I mean, it's one of those things. It's the beautiful thing about having a credit union that you work with, that is your credit union. We are there for you. And when you're ready to do a loan, like a mortgage or something large like that, we're here for you, or whoever you bank with. But it's so true. So one of the things the next thing that we're going to talk about is knowing your finances. So we talk about budgets almost every week in one form or another, but the budget is the best way to get to know your spending habits. On our screen, if you're with us online, you can see on our screen that we have a needs and wants financial plan for one of our members. If you're not with us online, we'll talk about it, but just know that we're going to discuss budgets and how making sure that you can afford your payments and differentiating between your wants and needs. So Herschel, can you explain a little bit about the difference between wants and needs?
Yeah, I'll be happy to. Thank you. You know me, this budget, this budget word is used a lot because your budget really truly impacts your weekly and your monthly expenditures, right? And Kelly has said it so well in the past, and I'm going to steal it. If you have more months left than you do money, then you're in trouble, right? So when she first said that, it kind of resonated to me, and I'm like, man, if that resonates to me as a financial counselor, how profound will it be for it to resonate with someone who's not within the financial arena, right? So personally, as a counselor, whenever I sit down with a member to help them create a budget and discern their wants and their needs, I typically have them fill out a budget, right? And be completely honest with what they're putting on that budget. In addition to that, I'll typically take anywhere from 60 to 90 days of their transaction journal. We're moving into, more usage of debit cards than we are cash, and a lot of those things help suppress a lot of fraud and such. So the transaction journal is going to define like all of their spending habits, right? So what I'll do is I'll sit down with that transaction journal, and I'll go through and I'll highlight. I'll grab a green and I'll grab a yellow, right? And I'll sit down and I go through that thing and I'll see what all the utilities, monthly utilities, expenditures, and what those true needs are. And then I'll go through and I'll highlight in a different color what those wants are, such as fast foods, going to the movies, monthly subscriptions for Amazon, cable TV, etc. Right? And what we'll do is we'll sit down and we'll look at that budget. We'll see what's coming in and what's going out, and then we'll compare it with that transaction journal to see where your money is truly going and where we can actually reduce some of that spending to help create that savings to purchase something that you've wanted and desired for such a long time, but more importantly to the topic that we're discussing today, and that's potential down payment towards a home purchase, which is a dream for most. So that's how I help in the counseling area, in the counseling department, Kelly, and I hope it was helpful for those that may not be, and they can do it themselves. It's something you can do for yourself. You don't need a counselor necessarily to help.
Absolutely.
You really don't.
Thank you, Herschel. And it's important to note that things like a place to live, your electric, your car payments, car insurance, things like that are needs. You need to sit down with the budget, and we do have that on our website. Kelly, what's that web address?
Yeah, if they just go to envisioncu.com/counsel, which is COUNSEL for counseling. That's our counsel page. They can find a fillable, basically Excel spreadsheet right there that they can use and print and save at home.
Perfect, thank you. And it's important to note that usually the things on the first page of that budget are needs, and the things on that second page tend to be wants. So when you're, like Herschel said, when you're trying to figure out how to save money for a big purchase, whether it's a house, a car, something, whatever it is that you're saving money for, it's important to decide whether those wants are, you want more than you want your house. So, I mean, if your house is your primary goal, and you know, that data plan for a cell phone, or the extra channels on the cable TV,
right,
if those are really, you need to decide if those are really worth it. And if they're not, then that money can get moved over to savings for the big ticket item. I mean, for the goal. So,
right.
And the example that we have on the screen, it shows the lady actually does have it all budgeted out. So her expenses for wants look like they're around $360. And the easiest way to save for her would just to cut out those wants and put that money in savings and put it towards her bigger goal, long-term goal. Short-term, what is that comment, Herschel? Short-term sacrifice for a long-term.
Short-term discomfort for long-term comfort. You got to exchange something for something. You can't have it all, right? You can't have your cake and eat it too, right?
Right. It'd be nice if we could.
I never really thought that statement was very nice anyways. Like,
No,
we have our cake and eat it too. You know?
Oh, God, here we go.
That's mean.
Mean, gosh.
Okay, so another one of the 5 C's is capacity. And so lenders use the DTI to calculate your capacity.
Kelly, what's DTI though? Like I hear that being asked so much, not only on social media, call-ins, people that are talking finances on some of the call podcasts and things of that nature are being shared. They always reference a lot of these acronyms and things of that nature, but it goes completely over their head. They're already confused, upset, and anxious about the experience and the opportunity. So can we kind of define what some of these what do we call it? What's the gibberish, or what is it most people call it when they can't understand a foreign language? This is what it sounds like to a lot of the consumers that are out there wanting to go through this, right? They're scared already. Can we help them?
Right.
Sure. So the DTI is the debt to income ratio. And so the debt to income ratio helps the lender decide if you are qualified to purchase a home. There's a percentage that if your DTI is over a certain percent, you definitely will not qualify for a loan. Kelly, can you share that number with us?
Yeah, so the threshold is 43%. Anything over 43%, you're most likely not going to qualify for a mortgage. If you're a first-time home buyer, they're going to probably send you back with an action plan and say, you need to work on getting some of this paid off before you can qualify, because it just shows that they're too risky. And the reason why that is because You're really only talking about the DTI is only those total monthly expenses that are showing up on your credit report. Because we also know that you have other
Obligations. Yes, you do.
commitments that you're making on a regular basis, right? So your actual debt to income is much higher.
Kelly, you said something in the beginning. You said that there's a potential that the lender may send you back to do some finances or fundamental home. Is this normal in the home purchasing process? Is this normal for even an A+ member or potential purchaser to have to go and do, is really to look at their finances and come back with a creative budget to make sure they know what their DTI is and they understand why they're being given this amount to shop, but potentially having this much to actually lend? Like, is this normal? Is this normal for us to have to go through?
Kelly, I'm going to take this one. I wouldn't necessarily say it's normal. Yes, for some people it is, but if you've really done your homework and you know what your credit score and you know what your income and everything is, if you've worked through all this, it shouldn't be an issue. So our goal here on this is to teach you what they're going to be asking for so that you're prepared for it. But does it happen? Yes. When we bought our first house, we had quite a few friends also buying houses at the same time, and they were jumping through hoops. Like, you know, they'll tell you don't make any large purchases before you close on your house, and that's because it's going to affect your debt to income ratio. So depending on where you're at in this process and how much you've educated yourself on the process, it's very possible that that's going to be a question that you're going to be asked.
Thank you for clarifying that.
Mm-hmm. So to get back to the DTI, just so you know, it's the total monthly expenses. And again, as Kelly mentioned, it's the expenses that report on your credit, not all the other stuff, but it's your total monthly expenses divided by your total monthly income. And hopefully it's less than 43 when you start this. If not, we need to look at your budget and get some stuff paid down, maybe get rid of some of those wants and pay that money towards your needs and get those numbers down below 43.
Agreed.
Because that's a step in the right direction. And so your credit score. So the big 3-digit number that reflects your personal credit history.
That's your promise. That's your promise to pay back.
Yes.
That's your promise that Kelly said report card. Hey, listen,
right.
whenever I knew I was going home with a report card, I want to do everything I possibly could to make sure that I emphasize, you know, the A's and the B's so that it overrides some of the lower scores I have. You don't have that opportunity with your credit. It's a one-stop shop. Like you are reflective of that 3-digit number and your promise to pay back. This is critical whenever you're shopping for homes and interest rates that are associated with your score. I mean, this is good stuff. I like it.
I believe and correct me if I'm wrong, but I believe the minimum credit score to purchase a house is 640.
Yes.
I believe.
Right.
So
which is B credit tier.
Right. So know that right from the bat that if you don't have a 640 credit score, we need to work on some things before you even get to this process. So it may be a couple year process for you, but a couple years goes by that quick.
It does.
Yeah.
Hey, really quick, I'd like to share a quick testimony, really quick, 30 seconds. So I had a couple of members that reached out to me back in November. And if you haven't, refer over to our Envision website, as well as on Facebook, and you'll see this testimonial. This story is so touching, right? So it lets you know that the potential to succeed in your home purchase is very viable, right? It's very, very viable. It takes discipline, but it takes you to practice that discipline on your part. We can't do everything for you, but let me tell you this really quick. Back in November, I had this beautiful couple. She was a Leon County school teacher, and her husband also worked. Both full-time employees, have a few kids and a newborn. And one of the things that the missus shared with me, she came to the first consultation, right? She was the first one. She was so ready, so motivated, but at the same time she was very, very nervous also, because she didn't know what, one, the process through the financial counseling would look like, but two, what the home purchasing process would look like, because that was her ultimate goal, right? We did a short-term, mid, and then a long-term goal. Her ultimate goal was to own a home. I said, well, give me basically a timeline of what your long-term goal is, what you're wanting to accomplish. She said, I don't know, Herschel, you know, maybe a couple of years. I said, well, I'll tell you what I'm willing to commit to. If you get aggressive and you show me that everything that you're doing is contributing to it being a favorable process for you and you're not abandoning the process, I'll do everything I can to make sure that you and your family have the most beautiful Christmas present in 2020. And she said, there's no way, Herschel. I said, there is a way, but you've got to meet me halfway. So let me tell you how aggressive these two were. They really reduced their debt. We did some debt consolidation stuff, and not to overshare anything personal, but let me tell you how aggressive they were, making sure that that long-term goal was accomplished in 2020. They closed on their home in June of this year. November of last year, they came to meet with me. And this is no pat on the back, because again, it's 50-50. I give what you give, and it's vice versa. I'm here for you as well as credit union, but you've got to know that it takes some action on your part too. June, they closed on their first home, even in the midst of a crisis as large as COVID-19, they still came out successful because they stuck to the plan. The circumstances didn't change their budget. They didn't change. They didn't work outside their budget. They further reduced their expenditures so that they could have more to contribute to, one, their debt, so that their score continued to go up, and now they're living in their brand new home. I just wanted to share that. So listen, guys, the dream, it can become reality. It just takes some action on your part.
So not only did their DTI go down, but their credit score went up because they got rid of debt that they didn't need to have. So
Absolutely.
And it allowed them to get the house that they wanted to get. So that's awesome. I mean, that's very aggressive. So good for them.
That's an awesome story.
Yeah.
Thank you.
So credit scores are one of our most well-attended webinars or classes that we teach. And there's a reason for it, because people just don't understand the credit score. They know they have it, but it's the mystery. So we've talked about it before. If you have questions about understanding your credit score, you can go back and look at our webinars. But what affects your credit score is your payment history, your amounts owed, your length of credit history, the types of credit used, and new credit, what you're applying for. And again, I said it before, but when you apply for a mortgage, they'll say, don't apply for any new credit, because you don't want all those hits on your credit, because it's going to drop your credit score. So checking your credit score. For a fee, you can get your credit score through a credit bureau right now. You can always do annualcreditreport.com and pull it once, but because of COVID, you have the opportunity to pull it once a week from the top 3 credit reporting
Wow.
once a week through the end of the year.
Wow.
So if you can't stay on top of your credit right now, it's not going to happen.
That's where that 50-50 comes in, right? That's where that 50-50 comes in. When I just said, hey, listen, they can meet you halfway by giving you the tools and the resources, but it's up to you to take action and make sure you're doing everything. Now is the time to start focusing on your credit. They're giving you access free every week to check the status to make sure that everybody's reporting accurately and that you're able to see what's going on your credit. Guys, you've got to protect it from your part. It takes your part too. I promise you it does.
And credit reports can be kind of scary and kind of strange to look at and hard to read. If you don't understand it, find somebody that does. Reach out to us, reach out to your loan officer, reach out to somebody and let them help explain it to you.
Absolutely.
And then if there's things on there that shouldn't be on there, dispute them. And you can dispute them right through the credit agencies. So, that's part of doing your part. So you're going to make sure not to get more credit. You're going to make sure to check that your credit score is accurate. And that anything that's on there that shouldn't be on there, that you're going to address. Don't just let it go, because it's not going to go anywhere. You have to take that step in and make it happen. So again, annualcreditreport.com, and you can pull it once a week through the end of the year. The credit score is one of the most important things. And again, you have to have a 640 credit score at least. And the higher your credit score, the better your interest rate is going to be. And that's an important one, because although you qualify at 640, I promise you, the interest rate that you're going to get at an 820 is going to be a better interest rate than you're going to get at 640.
Absolutely.
And so now we're going to talk about home buying costs, and we're just going to do an overview of this. But so when you talk about buying a home, it's just not what the payment amount you can afford is, or what the house amount you can afford is. So the basic rule of thumb is 2 to 3 times your annual household income should be what you're spending on a house. But it's just not being able to afford that payment. I think there's another way to do it. It's 28% of your monthly income is a good payment. A good payment amount for your home expenses. So not just your house payment, but all the other expenses that come with it. And we'll talk about that in a second.
Like paying the lawn guy.
Yeah,
Right.
like paying the lawn guy. 'cause I'm not mowing.
And they get expensive over time, guys. They get expensive. They get more expensive. They got to buy new equipment to keep up the lawn and everything else. So they got to go up about $5 a year.
That's right. So when we're talking about home buying costs, we're talking about down payments, we're talking about miscellaneous costs, and we're talking about closing costs. Because a down payment and a closing cost, those are two totally different things. So let's go to the next slide. So a down payment is the cash payment towards the purchase of a home. So typically it ranges between 3 and 20%. And that's just what you're putting down in a house. So Marta wants to buy a house that costs, we're going to use an example that we can see on the screen, but we have a member that wants to buy a house that's $80,000. So Marta has, in one example, Marta has 0 to put down on the house. So because she's not putting as much down on the house, her interest rate is a little bit higher. So she's going to get a 5% interest rate. And at the end of the first year, she will have paid $3,900 in interest on that $80,000 loan. In the second example, she saved up $20,000. So she's got $20,000 put on as a down payment. So that means that she only needs to borrow $60,000 from the bank instead of $80,000. She gets a little bit better interest rate because she had money to put down. So her rate is 4.5%. Now, 0.5% doesn't sound like that much, but on a mortgage, it sure is.
Oh, yes, ma'am. Especially long term when you're looking.
Yes.
What we're failing to make known though in this scenario, she's automatically got equity built in with that down payment that she uses toward the purchase of her home. That's automatic equity. That means that if should anything go wrong with the home, she can tap in and access the value of her home, pull out some cash, have it completed, and repair it on the home without there being any type of complex issues outside of signing additional documentation. That is a cash cow. That's the biggest form of funding access that you can get a hold of is a home, your home. So that's why it's very important to understand the down payment piece, the interest piece, all those things come into play, not only from the moment you stroke the pen, but long-term throughout that home's life as well. So again, built-in equity.
Herschel, that is something I didn't even think about. So thank you for sharing that.
That's
with having a lower amount that she had to borrow and the lower interest rate, she saved about $1,200 the first year in interest. That's $1,200 she can put somewhere else because that's just money that you're throwing away because you're paying interest on it. So then there's the miscellaneous costs. This is the one thing nobody talks about. And you need to be aware that it's out there. So Kelly, can you share a few of these costs with us?
Yeah. So, there are things like, and we won't necessarily go into detail about some of these unless you guys think it's important to, but one thing is when you get pre-approved for a home and you start to fill out paperwork, all of the initial costs that you have to pay for will be disclosed to you by your lender. So you can find out what the costs are for some of these, like an inspection cost, if there's a cost to run your credit check, an appraisal cost, all of those things should be disclosed to you. But then there are things that might be ongoing that you don't, obviously you can't know ahead of time because none of us have a crystal ball sitting house that, or wherever, telling us this is how much it's going to cost to repair this home. Now you can get an idea from inspection reports on initially what repairs you may have to do after you close on the sale of your home. So you're going to have to decide, is that money that you're going to invest in or spend to invest in the home to get it repaired correctly, right? And then ongoing costs, of course, that you're going to have to cover that may not be repair related, maybe more maintenance related, or gosh, I even think about property taxes. Property taxes change year over year. So your property taxes could go up, and it will. So, that is an increase in the monthly payment that people sometimes don't consider. If they're already at the very top of their budget when they close on the home, then property taxes goes up the next year and it changes your monthly payment by $50 a month. That can really strain a household. And then if you have some unforeseen income flow change, right? Someone's sick,
Loss of employment.
loss income,
Yeah.
right? Loss of employment. That's where people really get stuck in situations because they didn't foresee that or plan for that to happen. Closed on a home that doesn't allow them any cushion in the event that some of those unexpected things come.
Oh man, spot on.
Absolutely. And and one of the other ongoing costs, and you mentioned the taxes, but insurance is another one, especially in Florida with the storms that came through. I've noticed the insurance. I mean, if it goes up $500 a year, that's going to affect your mortgage payment, unless you're paying it outside your mortgage, but that's still going to be one of your mortgage expenses that you're going to have. So it's always good to prepare for the unexpected as much as you can. One other thing that was on the other slide that I would like to, that's okay, that I like to touch on is the inspection costs. Not every lender will tell you that you have to have an inspection, but it's worth the money to have the house inspected because you didn't build it.
Peace of mind.
Yeah, you can't see through the walls, and you could save yourself a ton of money. And if nothing else, like Kelly had mentioned, you know what expenses you're going to have once you purchase that house. You know if there's a window that needs to be replaced or the roof is only has a couple years left. It gives you that peace of mind, hopefully, and it doesn't cover, I mean, they won't catch everything, but hopefully you'll have that peace of mind and know, well, I'll need X amount of dollars by this time. So an inspection pays for itself.
Yeah.
Yeah.
A lot of times.
Also,
Go, please, Kelly, please.
I think it could also help, like for some people, if there's something that is revealed through an inspection, even though you have put an offer in on a home, you still have power. So you might be able to get yourself a really good deal. I love watching those home shows on TV where, they go and they visit like 3 or 5 different houses, and then sometimes they usually offer a lot less, and you can use the inspection results as kind of validate why you feel like the home is a fair price, for lower than maybe what listing price was. Of course, it depends on what the market is at the time, but you certainly could use that to help save you a significant amount of money. If you know that the roof has to be paid for in the next 5 years, but it's healthy enough to pass inspection for the lender as far as, okay, we'll go ahead and do that and not make it contingent upon the sale of the home. That, okay, I don't know about you guys, but a roof,
10 plus.
Any of you guys are not homeowners. We just replaced our roof last year or 2 years ago. A roof is probably one of the most expensive investments you'll make to repair. Okay, depending on the size of your home, the steep of your home, all those things. I mean, it's expensive. So guys, unless you have $10, $20, $30,000 laying around, like that's something you need to keep in mind in the future, right? So to kind of talk about, to echo what you're saying, Kelly, inspection costs is absolutely huge. These all are important.
I think what both of them were trying to say, Kelly and IE both, is that don't allow the excitement to cloud your common sense whenever you're going into this process. It's just like shopping for a car. You want all the bells, the whistles, but the common thing is you never buy a car at night or in the rain, right? You never go into purchasing a home blind either. You don't know what that homeowner previous to you, what type of lifestyle they had, or what damage may have occurred on the home to prior to them purchasing or building. You don't know these things, so don't go in blind. Don't allow the excitement to cloud your common sense. Please don't. This is a long-term investment that 2 parties are involved in. That's you and the lending institution. So make sure you're serving interest for both.
Yeah.
Okay, and then we have closing costs. So jumping ahead. So closing costs are expenses over and above the purchase price of the home. So we've got appraisal fees because the property has to appraise for what you're paying for it. Otherwise, the lender doesn't want to give you more money than the house is worth, because at the end of the day, that's their collateral until you have it paid off. So they're not going to extend more money than the property is worth unless you have other collateral to go with it, which is something that we talked about earlier. Tax service provider fees, title insurance, government taxes, because they have to get theirs, and prepaid expenses, the property tax, homeowners insurance. Those are all things that are due at closing. for a few months. I think the homeowner's insurance is 6 months. Interest is 30 days or 90 days or something like that. But in all that information is disclosed when you're doing the loan. You should know all that information well prior to closing. So total amount of closing costs are between 2 and 5% of the purchase price. I think Envision's runs around 3%, maybe 4%. But just know that those are other fees that you're going to have. So you have your down payment, you have your other costs, and then you have your closing costs. Some of them are included in your closing or can be. They can be included in your loan, but other ones you have to pay up front.
And can you also negotiate that in your contract, Kelly, where you can say, we'll purchase this home for this amount of money, but we also want you to pay our closing costs for us?
Absolutely. You have the option, and depending on the type of loan, it dictates what percentage you can ask the sellers to pay. And all that information will be given to you if you ask the question. But yes, you can absolutely ask them for that. I think our first 2 homes, we did that. We said, okay, we'll give you this, and this is what we want from you. And sometimes they'll come back and say, well, then you pay us more. We'll include it, but you pay us more. And that way you get it wrapped up in your loan. But just keep in mind when you do that the house has to appraise for that amount.
Right.
That's a very important thing. You can't add in, it can't be over 100% of the value of the house.
Right. And that's why it's important, I think, to really ask those questions to not only your mortgage loan representative, but also your realtor. These are questions
Absolutely.
that can help, facilitate through the connection with the sellers.
And if you have a good realtor, especially if you're a first-time home buyer, they will take the time with you and they will explain all this to you. And that's what they're there for. That's part of what you're paying them for. So, use that asset, because
Absolutely.
they've been there. They hopefully have done a ton of them, but they know all the questions that you're going to ask because other people have asked the same thing. So, and if they don't have the answer for you, they should be able to get it. But you can also reach out to your mortgage company, or if you know somebody at the bank or credit union, reach out to them and use everything. There's no dumb questions, and you don't want to be in a situation where you say, oh, I wish I would have asked that question because I'm in a terrible place right now.
Yes.
I should have just asked.
Very
Good
Very
questions. So speaking of 100% of the mortgage, there's another little add-on that's called private mortgage insurance. And so what that is it's insurance that the lender places on the mortgage if the mortgage is more than 80% of the loan. So if you have to borrow 90% or 100% of the value of the house, then they're going to add on the private mortgage insurance, or PMI. That's another one of those acronyms. So PMI. And it's a percentage of what the purchase price is, and that goes directly to the lender to cover in case you default on a loan. Because if you default on a loan early in the mortgage and you still owe 90%, by the time they foreclose and have to go and turn around and sell it, they're going to lose money. So they're not in the business to lose money. So they're going to tack on this private mortgage insurance. And there is a
good explanation. Thank you for explaining that. I've been, it probably took me about 3 or 4 years to really figure out and break down what PMI was, what was the use, what was the point of it, all these things. And at the purchase of my first home, I really got educated, individually. I personally took on that feat to educate myself because I knew that that wasn't my forever home. I knew I wanted to go through this process again, but I wanted to go through it with a little bit more knowledge and understanding than I did the prior time. So PMI was one of those things that I just could not dissect, but it took me a little while to really figure it out and understand what the use of the PMI was for there on the table at that time. But after the reduction of the value and all that good stuff, the loan balance, then the PMI is no longer needed. And I think that's something that's a positive thing for you to show that your stability has now granted you basically a discount on your mortgage.
Absolutely. And, and it's important to know that, again, it's a percentage of what you owe the lender. So it can be, I've seen PMI payments be as low as like $30 or $40 a month, but I've seen them with the credit union be as high as $361 was the highest I've seen. Now that was a very expensive house, but just know that it may just add a little bit to your mortgage payment, but when you're taking into consideration that you have a $1,500 a month payment, and then all of a sudden you have your taxes and insurance and your PMI, that $1,500 payment can be up to $2,200. And you're like, wait a second, I don't have that in my budget. So it's always good to know and to really pay attention. And private mortgage insurance is one of those things that you really need to focus on. If you don't have the 20% down, then just know that this is going to be a possibility that you're going to have private mortgage insurance.
Right.
Good stuff.
And you're paying to protect the credit union or the financial institution that you're borrowing from. So it's really not, it's kind of one of those that you're like, dang. Okay, and then there's different types of loans. We're just going to go as on an overview for these because you can get so caught up in all this, but there's different types of loans and you get them through financial institutions, your credit unions, and mortgage companies. There's websites that you can go to. Now, I'm going to give you the names of these. If you're watching this, you can see it on the screen, but make sure when you're going out to these websites that you're actually going to the proper website and not an ad that's up above it. So there's the FHA, which is the Federal Housing Administration. There's VA loans that are available for veterans and service members and surviving spouses, and that's the VA. And then there's USDA Rural Development Services. So again, when you're going out there, make sure that you're going to their actual website. And you can pull up all the information on those. And then if you have more questions, you're welcome to reach out to your lender. And then if we can go to the next slide, and then there's free resources out there too. And again, you're going to want to make sure that you're going out to the correct website. So there's the Truth in Lending Act, which requires that buyers be given information about key features, costs, and risks of their mortgages. So what that means is everything that we've talked about that goes into a loan, they have to disclose all of that to you. And you have to be able to understand it. You're going to sign off on it. Don't sign off on it if you don't understand it. Or if you have questions or if something's not filled in, you have to understand it because that's when you sign it, that's on you. So make sure that you're getting the information that you need. And then there's the consumerfinance.gov/owning a home. And that's the Consumer Finance Protection Bureau. You can go out there and get all the resources for buyers that are financing a home. And then there's the USDA, U.S. Department of Housing and Urban Development, which is HUD.gov. They have all the information about different home buying programs, first-time buyers, and just a plethora of information. And then USA.gov.
When you started to say USDA, I was like,
did, yes.
we're talking about meat now.
Wait,
Who's hungry? And normally it'd be me that's hungry. Normally it's me that's hungry.
hopefully, if you buy the right house, you'll still have meat to put on the table. So that's why I was
There
thinking.
you go.
That's a good one.
Maybe we should start giving away Envision branded steaks. It's a welcome gift to people after they close on their new mortgage.
Congratulations, here's your meat. Yes.
Here's your meat.
Yes.
Put it on the grill and we're staying.
But again, just make sure when you're going out there, first of all, that you don't go to USDA for the meat, but that you go to the right websites so that you get the proper information.
Oh, that's hilarious. Okay, and then the last one here, right? USA.gov.
Yes, USA.gov/finding-home. So all those are great resources to go to. And so it's just, in summary, it's just important to remember that you have to know your finances. You have to be ready, understand that you're ready to buy that house. And if you're not ready, be willing to say to yourself, you know what? I'm not there yet, but I'm going to get there. I'm going to reach out to somebody. I'm going to follow my budget. I'm going to do everything that I need to do to get myself in the right situation to buy this home. Be sure you understand your personal credit and your debt to income ratio. And again, remember that with your credit, the higher your credit score, the lower your interest rate is going to be. And that is huge when you're purchasing a house, because you might not think about it with a car. A car, 1% one way or the other might not make a big deal, but a house, 1% interest rate one way or the other is a huge deal. And then you must thoroughly review all the costs associated with homeownership before the process of purchasing a home. I wish that last one I knew when we bought our first house. I didn't really think much about it. And like Herschel said, it was kind of one of those things you just kind of went into blindly. And the day we sold our first house was the happiest day of my life, because we got out from under something that we should have never gotten into before in the first place.
Yeah.
Excuse me, in the first place. It was just, we weren't prepared for it. So don't be in that same situation. Take your time, be patient, and follow the steps that you need to follow before you jump in, and it'll be a wonderful experience.
Absolutely.
Yeah.
Absolutely. This has been a lot of information that we've shared. And while again, like I shared with you previously, that it can sometimes be overwhelming, don't forget that you have the ability to go back to our modules under envisioncu.com and review a lot of the content that we've shared, not only on screen, but in past webinars as well. This stuff is for you guys. Make sure you're able to understand it, retain it, and apply it to whatever it is that you're preparing to experience. We've got the resources in place for you. Number two, one of the last two things I'll share with you is Kelly mentioned, the truth in lending statement, right? I encourage you to read everything. Read everything, guys. And I've shared with you in the past, the bold print it giveth and the fine print taketh away. If you don't know what you're signing, you're going to hurt yourself before you even get to enjoy the benefit of the process that you went through to enjoy your home. And last but not least, prepare in advance, guys. It's okay to ask questions. It's okay to overwhelm your lender with questions, because that gives them the oomph to know that you're in this for the long haul. There's a difference between a pre-qualification and a pre-approval. Pre-qualification is just conversation. It's just you telling a lender what you potentially make, what your credit score could potentially be, and they're going to tell you what the market is yielding and what the rates currently are and what you could potentially afford. That's pre-qualification. All you did was had a conversation. What's most important is the pre-approval. That's what leads to an application. Not just a conversation, but an application. Now you're in the process. You've got your rate locked in, right? You know what your income and all those debt tools and resources that we provide you come into play, how they're applied now. It makes sense. So again, if I can share with you anything at all, go back and refer to these modules. They're not just there to fill up, online space or web space. This is for you to take advantage of. And if we can do anything for you to help progress whatever it is that's on your goal track, then let us help you along that journey. That's what we're here for. And I'm signing off. Over to you, Kelly.
Let me backtrack on Herschel one thing. When you're reading through everything, don't wait till closing to read through everything. Don't wait till you ask for those papers a couple days in advance and really take the time, because it's a stack. It's a big stack. Get those papers ahead of time and read through them. And then if you have any questions, you can highlight them so that when you're ready to close, it's a fun, relaxing experience. You close, you get your keys, and you're good to go.
Yeah. And, sometimes they don't have the paperwork ready until the day of, because the title company is really the one who's doing all that. So you got to ask the right questions to your lender, the representative with your lender, say, help me be prepared for what I'm going to read. What are some terms I need to look for? And because usually your closing's like scheduled to be less an hour or less. And, if you have all that paperwork, so do your homework first. And I think the thing too, is when you trust who you're working with, when you trust your realtor and you trust, obviously you don't usually meet your title company reps until the day that you walk in their door. But you can have a good feel for something, for people. Use your discernment to just say, I'm really sorry. I don't understand what that means. Can you explain that to me differently? Like, help me understand what that means, right? So that you can kind of get what they're talking about. Yeah, for sure.
Excellent. Yep. Well, I think we've covered it. Is there anything else that either one of you want to add?
You do those modules so we can get some people to win this $100, guys.
Yeah.
Good Lord, just do some modules. Like, we want to give you some money. We want to give it away, but more importantly, you can refer back to all this content and just pace yourself through it. 3, 5, 6 minutes, 7 minutes, and then you get an opportunity to win $100. That's dinner. That's gas for a couple of weeks.
So Herschel's talking about Herschel's talking about our monthly drawing. So when you go on to envisioncu.com/moneywise, you're going to be linked through to our financial education platform that's self-guided, where you can, on your own time, in your own comfort, in your own pajamas,
right,
you can complete modules and playlists so that you can educate yourself. And especially the wants versus needs ones is really cool. I think that's the one about doing a budget, because it literally says, how many of these things do you spend on in a week? Here's the average. This is how much save over the course of a year. So you can kind of plug those things in for yourself, which is really cool. But what he's talking about is, so a playlist is a main topic, and then the modules are underneath it. There's like 5 or 6 modules under each playlist. When you complete an entire playlist, you are entered to win our $100 gift card drawing for the month. So we only have a couple days left of the month that we're in right now. So go get a playlist done, win, and then buy whatever your little heart desires. Maybe put $100
Towards
I
your
don't know,
house.
aside for down payment on a house, or buy yourself something to motivate you towards home ownership, like a picture that you're going to hang in your
Right. Or a bottle of wine that you can sit down and have while discussing purchasing a home, right?
Yeah, that's right. Or a grill, put it towards a grill to grill the steaks that we're going to get you that are USDA approved. Branded with Envision, like branding on it. That's right.
Too funny.
Oh, that's awesome.
Well, I guess my last thing, Kelly, to that is, I say this a lot, and I'll probably bore you all with, hearing it over and over again. My advice would be to remember that, and a lot of us do this, I think, when we want to buy a car, we fall in love with the idea of it first, that we don't, like Herschel was saying, don't let the excitement and falling in love with the process cloud your, common sense judgment. Because a lot of times I think we're like, oh, okay, I want to buy a home. So we fall in love with the house. We're like, what do I need to do to qualify to get in that house? And a lot of times we're not financially prepared for it, or we've come in at the highest of our budget. And then all these things we didn't think now are hindsight, right?
Mm-hmm. And one thing too is, even if you're not in looking for a house, or you don't think you are, be prepared, because you never know. You may run across that dream house, and if you're prepared and it's in your price range, because you know what your finances are, what you can spend, you have money in the bank so that you can make that purchase if you want. How great is that, to know that you can afford that house that you fell in love with on a whim? That happened to us.
Yeah,
but
that is perfect.
And I didn't have to worry about it. I mean, we had a lot of steps to take in the end, but I mean, that's not the right scenario. But to be in a situation where you're prepared for anything is awesome.
Yeah. Well, and your first home is just that. It's your first home.
Yes.
Your first home does not have to be your dream home. You work towards that as you mature and develop and grow in the rest of your life, like your job, your career, your income, right? And be really realistic with lifestyle. Yeah. Very good. Thank you, Kelly, for leading.
Thank you.
No, awesome day.
Yeah,
Awesome.
You did a great job.
That's right. We all did. All right. We're superstars. And all this talking about steaks got me hungry.
You know what time it is for me, right? It's time to eat.
It's chow time.
It's always lunchtime for Herschel.
That's right. We'll see you guys next time. Thank y'all. And be good. Make good choices. That's what I always tell my nieces, right? Good choices. So, all right. We'll see you guys next time. Bye.
Thanks, guys.